What if I told you that with just 100 euros per month, you could grow your wealth and test different investing strategies in real time? 2 years ago, I started a practical experiment. I created 3 portfolios, each with 1000 euros as a starting point, and added 100 euros monthly to each since September 2022. Now the combined value has grown to over 16,000 euros. Beyond this experiment, I bring 5 years of experience in public investing education, a public portfolio exceeding 100,000 euros, and insights from helping clients invest over 15 million euros. This foundation allows me to share what works in the real world. Additionally, all of the portfolios mentioned can be tracked for free through the links in the description. In this video, I'll compare these 3 strategies. First, investing in the S&P 500 via VUAA ETF. Second, a global diversified All World ETF, VWCE. And third one, an actively managed portfolio where I buy and sell individual stocks based on my own insights. Stick around because I'll not only reveal which strategy is currently winning, but also share insights into how these approaches could work for you. By the end, you'll know exactly what I do if I were just starting with 100 euros a month. Let's dive in. Let's explore each portfolio strategy in detail. Let's start with portfolio number 1, S&P 500 ETF, which is VUAA. First of all, what it is. Imagine walking into a store every month and buying the same item, no matter the price. Sometimes it's cheaper, sometimes it's more expensive, but over time, your average cost is balanced. That's dollar cost averaging, or DCA, in real action. And it's how this portfolio works. By investing in VUAA, a low-cost European ETF that tracks the S&P 500, I'm buying a small piece of 500 of the biggest companies in the US every month. Now, the next logical question is why it works. The S&P 500 is like a hall of fame for businesses. Companies like Apple, Microsoft, Google, or Alphabet are all part of it. Historically, these companies have delivered strong returns, making the S&P 500 one of the most reliable ways to grow your money. Additionally, here's something you might not know. Warren Buffett, one of the greatest investors of all time, says that most people should invest in an S&P 500 ETF instead of picking individual stocks. Why? Because it's simple, low cost, and has a track record of consistent growth over decades. All right, let's check results so far. So after 2 years, the portfolio value grown to 5,183 euros. You can see that over 500 people is tracking this portfolio, and the returns are 36.4%. Now, 98% is in one position only, which is VUAA, and you can see that I've invested each month, like January, December, November, so on and so on and so on. And again, doesn't matter the price, I just continue buying it. Now, the trade itself is super simple. If we want to buy VUAA, you know that it costs $114. Simply top up your account by add money. Once you have significant sum, which is larger than the one individual unit, so over $114, you can simply enter 11426 current price, pick the number of units you want to buy, and there's green button buy and buy. It is that simple. Again, I'm sharing the practical side because I don't top up my account. It's on random occasions. It's 100 euros a month, restricted to that, just so I can compare portfolios individually. And don't forget, that includes the 1,000 euros starting point and 100 added each month. And the idea behind it, because on some of the portfolios I do active management, on some of them passive management, I normally compare the sums to see which one is growing faster, because the exactly same sum comes into the accounts, but what happens to the money within the accounts is sort of different. All right, let's have a look at portfolio number 2. All World ETF, or VWCE. Let's start again with what it is. Imagine spreading your bets not just on one country, but on the entire world. That's what investing in VWCE and All World ETF does. This portfolio uses dollar cost averaging, DCA, to buy a small piece of over 3,000 companies from around the globe each month. Logical question why it works? This strategy diversifies your investments across developed markets like US and Europe, and emerging markets like India, Brazil. If one region's economy slows down, others can balance it out. It's like having a safety net for your money that the overall businesses from the world will continue to earn money. And the idea behind it, that it could be one fund strategy. And so some people want to keep investing as simple as possible, and I encourage that. With VWCE, you can do just that. It's designed to be a one-stop shop for global investing, perfect for those who don't want to overthink their portfolio. Let's have a look at results so far. Now let's remember exactly the same part, the amount of money. So 5,183 in S&P 500 and 4,879 in the All World. Now it's not as impressive if you compare it to specifically S&P 500. But again, it's a dollar cost average strategy. It takes me 1 minute a month and I continue investing in just one unit again and again and again. And you can see that strategy overall works. It just works a little bit slower if you compare to the biggest economy in the world at the moment. So a bit of a sort of thought process here is if you want more diversification, you'll have to sacrifice a little bit on return. All right, final one, portfolio 3, active management. Now, what is? Let's talk about the most hands-on approach, the active portfolio, at least from my side. Here I've been buying and selling individual stocks based on my own analysis and insights, and sometimes just random picks which I want to invest a little bit more attention to. So I invest a little bit of money first and review the company later. It's in a way like cooking your own recipe rather than following one. Now, the challenge with active investing is that even experts can struggle to outperform the market consistently. It often comes down to timing, which can feel more like luck than actual skill. So why do I do it? I've always believed in learning by doing, and while I don't expect this portfolio to outperform the passive strategies over time, it's been a valuable learning experience. Plus, it's exciting to see the impact of my decisions in real time. Now, let's have a look at the results. So far, I've been super lucky. This portfolio value has grown considerably and currently sitting, let's see, at 6,671 euros, which outperforms the passive strategies by a significant margin. Now, some of the stocks you can see in my portfolio are currently only 3 positions because I buy in, I sell them. And some of the choices I've made been super successful. So if I jump on trades, you can see the history. Some of them have not been so successful, but the last few, for example, only been like less than a month. And from the investing position I actually added, it's been like 50% return, 80% return, plus quite a few other green ones, some of the red ones as well, which allows me to actively manage and review the portfolio and actually see when I want to buy some individual stocks and when I want to keep them. As I mentioned, you can track this portfolio through the links in the description. You would have to become a user of Freedom24. This is the broker I use for majority of my accounts. Just remember, this isn't a recommendation. It's, in a way, an opportunity to see how I approach investing and how I generate ideas to review yourself and to potentially invest it by yourself. Now, the key takeaway, active investing takes time, carries high risk, and relies heavily on timing. So while the results are great now, they might not always stay ahead. Now, let's remember the idea of how I compare portfolios. To evaluate these portfolios fairly, I use tools like Snowball Analytics. There's free version, but there's also a paid version. You can check in the description if you want to review that one. I might do a guide on that one in the future, but the idea is to compare it on 2 levels. One easiest way to compare is by looking at the total sum of money in each portfolio. However, we also must consider transaction costs, currency conversion fees, and potentially taxes to get a true picture of net returns. Another useful metric is the average annual return, which allows us to compare different investments made at different times. And that's where Snowball Analytics works a little bit better rather than just having your own spreadsheet. This provides a clear perspective on performance over the long term. Now, if I was starting today with just, let's say, 100 euros per month, I'd keep it simple. First of all, I would pick a strategy. Imagine building a house. You need a strong foundation, and that's exactly what a passive investment like S&P 500 or the All World ETF provides. These options are low-cost, diversified, and easy to set up. It literally takes me less than a minute to invest each month. Secondly, I would focus on consistency. Think of your investments like planting a tree. If you can automate your contributions and water it regularly and over time, it will grow into something strong and valuable. Consistency is the key to compounding. Of course, the big sums help, but sometimes starting small is more efficient. Third one, don't overthink it. Spending hours worrying about every market move can be exhausting and unproductive. Stick to your plan, trust the process, and focus your energy on earning more or enjoying life. For those wanting a one-and-done approach, the All World ETF is a great choice. It gives you a global exposure with just one fund, making it simple and efficient for beginners and experienced investors alike. For the ones who believe that America remains the strongest power in the world in the future as well, I believe the UAA or S&P 500 index is a more appropriate choice because historically it outpaced the rest of the world. So why invest in all world when you can choose just the specific economy which grows faster than the rest? Now this experiment is a long-term journey and we're just 2 years in. The real magic of investing is compounding, which accelerates over time. If you are curious to see how these portfolios grow in the years ahead, hit that subscribe button and follow along. Remember, best time to start investing was yesterday, the next best time is today. Whether you choose an ETF or another strategy, the key is to start now. If this video inspired you, check out the links in the description to explore the tools and resources I use to manage my portfolios. These can help you get started on your journey today. And if this video helped you, give it a thumbs up, share it with a friend, and don't forget to subscribe for more practical investing advice. Let's grow our wealth together, €100 investment at a time. See you in the next video.